Hello, everyone. Welcome back to another episode of King of Commercial Real Estate. Marjorie Roman here, and we have the king in the house, Dolf de Roos. Thank you so much again for coming today.
My pleasure as always, Marjorie.
And today we're going to be talking about how to value your commercial real estate deals. Because there's so many metrics to actually measure if your property is going to be a good one to invest on or a bad one. So the first one is, what about the cash on cash return? What is it, and how do you go about calculating it?
Well, cash on cash return, that's normally one we discuss later on because it's the cash that you pull out after everything has been paid based on the cash you put into the deal. So maybe we should use some numbers. Now, I know not everyone is number-centric and they get bamboozled by numbers, but the smallest commercial property I ever bought had a purchase price of $59,000. So maybe the big lesson from that is that you don't need to necessarily spend millions of dollars to buy a commercial property. Here I got one for an outlay of $59,000.
Oh, wow.
And I went to the bank and I said, I'm buying this property. Can you send your appraiser in, your valuer? And bank appraisers are usually very conservative. They don't like to give an optimistic value. So they went in there. This was a good deal. And they said, well, it's got to be worth $80,000. And they were willing to lend me 70% of the appraisal. So they lent me $56,000. The purchase price was $59,000. So the question is, how much cash did I have tied up in this deal? And forget closing costs and all that sort of thing. Essentially, I only had $3,000 cash tied up in the deal, the difference between my $59,000 purchase price and my $56,000 mortgage that I got from the bank. So my cash in was $3,000. What did I get out of the deal? Well, the rental was $10,000 a year, and it was a triple net lease. It's commercial, meaning the tenant paid the outgoings of property taxes, insurance, and maintenance. So that means I was only up for the mortgage. Now, interest rates were quite high back when I got this property. So interest and principal was about $5,000 a year. So I was collecting $5,000 gross rental, and I only had to pay the mortgage, which was about $5,000. So I pulled out $5,000. So let's look at two returns that we can discuss just from the numbers we've gone over. My raw return, my rental income divided by purchase price was my $10,000 a year rental income divided by the $59,000 purchase price, which I think is about 17%. I'm not using a calculator to check or confirm that, but about 17%. And is that good or bad? Well, it just is. It depends on the market and all kinds of other factors. But my cash on cash return, well, my cash input was only $3,000, and my net cash out after paying all expenses, including the mortgage, was $5,000. Well, $5,000 divided by $3,000 is about 160%. So surely they can't both be right. So my question to you is, was my return 17% or was it 160%? It's the same property.
I would think that it was the 106% at that point.
Well, the truth is both are accurate. One is the rental income divided by the purchase price, and the other one is the cash out divided by the cash in. And there are many other forms of return, and I'm sure we'll be discussing some of them right now on this podcast. And it just depends on your definition. So I like to look at all of them. I like to get a feel for what is the cash on cash return, but also what is the raw return, because you don't want one number to be out of kilter with the others. And if all the indicators look good, then it sounds like a good deal. But I like it where I only put $3,000 in and I'm getting $5,000 out every year. I get the money required to buy the property back every year and then some. That's a good deal in my mind.
That's right. And that's, again, one of the many numbers that you were looking at before you actually purchased that one deal. We did mention that there are other metrics that we'll look for. So, for example, what about the ROI? How do you go about calculating the ROI on a commercial property?
Well, the ROI, that just stands for return on investment. So you could argue that your rental income divided by the purchase price is the return on investment. But it doesn't take account of all your expenses. So if you take account of the mortgage, then your ROI is going to be different. And if you want to do that pre-tax or after-tax, the numbers will be different as well. And by the way, with most businesses, if you earn $5,000 after paying all your expenses, well, in this case, the tenant paid the outgoings, but you've paid your mortgage and you're pulling $5,000 out, you could normally expect to pay tax on the 5,000 profit. So let's say you have a flower shop or a bicycle repair shop, and you earn $10,000 in income, you have $5,000 in expenses when all is said and done. So you're making $5,000 net profit. That's pre-tax profit. You would expect to pay tax on that. But in real estate, even though you have to account for everything with the taxman, it's not always a foregone conclusion that you will be paying tax. For instance, you have a thing called depreciation. We sometimes call that a phantom deduction because you can depreciate the building. Again, it varies country by country, but in the States, it's usually on the basis that a commercial building has a useful life of however many years it is, 40 years or something. So you can depreciate it at 2% a year or 2.5%. And then there are other things that you can depreciate at a higher rate, like the building, the floor and the walls can be depreciated at that 2.5%. It's slightly higher for residential buildings. They have a predicted useful life of 28.5 years or 27.5. I don't even know the number. And it doesn't matter because do they really go in value down to zero after 28 years? No, they go up in value. And the government knows they go up in value. So you could ask, why would the government allow you to depreciate something as if it goes down in value to zero when in actual fact they're smart enough to know that real estate goes up in value?
Is that like an incentive for the investors? Is that why they do it?
Exactly. There are two reasons for levying a tax. One is the obvious one of generating revenue that they need to provide all the services they provide. And the other one is to shape social policy. So they'll have a higher than normal tax on cigarettes and alcohol as a way of trying to discourage us from consuming too much of it. And similarly, the government knows it's not very good at providing accommodation for the needy, so they will give incentives to people like you and I to provide accommodation. It's called rental incentives. They'll have incentives for people to invest in real estate. And one of the incentives is a depreciation allowance to allow you to deduct a percentage of the building as if it's going down in value, even when they know full well it's going up. So you can claim depreciation. So back to our building, $5,000 net income. If you've got $7,000 of legitimate depreciation, then even though you're making a $5,000 cash profit, on paper, it looks as though you're running at a loss of $2,000. And depending, again, on the jurisdiction, the country or the state you're in and the rules they have, you might be able to claim the loss, the $2,000 paper loss on that profit against other income. And if that's the case, the government is essentially subsidizing your loss, but it's only a paper loss. So you're getting money from the government on the basis that you're running at a loss. So let's say they give you $1,000 because you're into negative cash flow. That means your true return is no longer 5,000, it's 6,000. So as I said, with any other business that I can think of, when you make a $5,000 after all expenses have been accounted for profit, you expect to pay tax on that and your take home will be less than the 5,000. But with real estate, it's very possible and indeed common for your take home to be higher than your net because of depreciation.
That's interesting. And it's really cool that actually the government sees that there's a value on having investors within their country.
Right.
Now, another of the metrics that you mentioned is the internal rate of return. What is that metric and how do you go about calculating that one?
I'm impressed that you had the gumption to ask that question because we aren't equipped here with graphics and explanations of the word. The internal rate of return, most accountants have a definition for it that is accurate but very confusing, and I'll do my best at giving a rendition of what an accountant would say. An accountant would tell you that the internal rate of return is the return that you would have to get so that if you took all the future cash flows you're going to get from the building, future income streams and future capital values, and you take their net present value and you sum them together, you would get a return that is equivalent to if you put that money in the bank.
Oh.
Yes.
All right.
Technically accurate, but you're none the wiser as to what it means.
Right? I mean, I don't know if I could actually calculate all the many different types of cash flow that I would get on a...
Right, and what is a net present value? So I want to give you a different definition that I think is easier to understand and makes more sense. So we buy a property, we put cash in up front, and then we expect to get rental income every month. And then we have to pay for expenses. Your insurance premium might be paid monthly or once a year, and we have other expenses, maintenance issues, property taxes. Sometimes they're paid once a year, sometimes twice, sometimes 4 times a year. It depends on the jurisdiction again. And so at the end of every month, there's a net cash in or net cash out. And then in the meantime, if we were to sell the property at the end of, say, 5 years, it might have suffered capital growth. It could have had a capital loss as well, just to cover all bases, but let's assume there's a capital growth. So in essence, by buying a property, we have a series of cash flow transactions with that property. We might put in $20,000 to buy the property, then we pull out $1,000 a month, net, rental income after all expenses. And at the end of 5 years, if we were to sell it, we might pull out $50,000. The internal rate of return is the return that a bank would have to offer you, such that if you gave the bank that same $20,000 and then got from the bank $1,000 a year or a month, whatever, from that net rental income, and then at the end of 5 years, they gave you your capital growth after paying tax like capital gains tax. It's that cash flow sequence. In order to have that cash flow sequence with the bank, what interest rate would they have to offer?
Gotcha.
And usually it's a lot higher than the ROI because it takes the capital growth into account. But that's why it's so important, because with real estate, you not only get a cash flow situation, usually positive, but you get the capital growth. So the IRR, the internal rate of return, takes account of the cash flow and the capital growth. It's a very powerful tool to use, but you have to understand what it is. Otherwise, it can seem extraordinarily high.
That's right. And I feel like at the same time, when you were mentioning how this explanation is way better than the one that an accountant would give you, it's because like sometimes accountants, they are not even investors themselves.
Oh, that's the big reason.
And
And when you think about it, an accountant is trained to analyze things that have happened in the past right up until today, right up until this moment, but they never look into the future. And a real estate investor has to take into account the past, obviously, for accounting purposes, but I'm not really interested in what happened yesterday, let alone last week or last year, or even an hour before this podcast. I'm interested in what's going to happen from right now, this moment, looking forward, and what can we do strategically when it comes to real estate to maximize our return. So accountants are trained to do the very opposite of what I think real estate investors are trained to do, even though we need them, of course, to do the accounting for our property portfolios.
that's right. There's still a really good profession that we usually reach out to as investors, but let's make sure that when we are consulting about all of these investments is with another investor that is a little bit more experienced than us.
Right.
Now, another of the numbers that or metrics that we analyze is also the return on equity. What is the return on equity, and how do you calculate this number?
Well, let's say that you're putting in $50,000 to buy a building, but that you're also getting a loan for $200,000.
Okay.
Then you want to know what is the net cash flow to you, the equity investor. So you want to take account of the rent that you're collecting, that's income, or the expenses associated with the property, the electric bill if it's a gross modified lease, the insurance, the maintenance, you name it. And then you also want to take your debt servicing into account, because there's equity financing and debt financing. So if we've got that, what did I say, a $200,000 mortgage from the bank, and it's a 5% interest, and that's $10,000 a year, then we have to account for that $10,000 to service the loan, and that's just interest. There might be principal payments as well. So whatever is left is going to constitute your return on the equity investment. So it's just another metric, and it's important. And why is it important? Because if you've got a variable interest rate loan and that interest rate goes up, then it's going to affect your return on equity.
But in the case of the states, I've noticed that for quite a bit of the mortgages that we get for a property, they have a regular rate that is just going to stay locked in for a certain period of time. How do you go about calculating the return on equity on there? Would it be easier given that the rate is not as variable as on the other loans?
No, you can get a return on equity whether the rate is fixed or variable. Here in the US, most mortgages have a fixed rate, or most people can get them. You'd be silly not to get a fixed rate mortgage, whereas in most other countries that's not possible.
Oh, wow.
But there is a notion of a return on equity, whether your interest rate on your mortgage, your debt financing is fixed or variable. So it's just more easy to predict what your return on equity is going to be in the years ahead, where you have fixed the interest rate on the debt financing. That I think is self-evident, but you still want to know what your return on equity is.
That's right. All of these numbers, all of these metrics are truly important on really assessing if the property that you're looking at is a really good deal or not. Out of all of these metrics, do you have any favorites, or would you recommend us to use all of them within our tool set?
I think use all of them, be aware of all of them. The more you fiddle around with them, I like to do what's called a sensitivity analysis. How sensitive is this property to a change in the rental income, if it goes up or down, or to a change in the mortgage interest rate if it comes to that? And then I like buying properties where there's low sensitivity, where if the rent were to fall off by 10% because one of my 10 tenants dropped out of the mix of my tenant pool, that I'm not going to go under or bankrupt. So I think look at all the numbers, and the more you're familiar with it and you're calculating these numbers in your head or on paper or on a computer, the more you'll gain confidence that you've come across a great deal.
That's right. And if anything, the more deals that you end up calculating these numbers for, you can even automate them by having an Excel spreadsheet that you can easily input the numbers so you can have a better idea of the deals that you're looking at.
Exactly, yeah.
Thank you so much, as always, Dolf, for your explanation on all of these metrics that we need to be aware of for purchasing our next deals. See you on the next episode, you guys. Bye.